All right, welcome everybody. I am here today with Haley Burt, I guess, as far as the preferred name, right?
Yes.
And Tim Jordan. And so we're going to have a great discussion about a topic that is, I think, is it's not talked about enough because for a lot of businesses, a lot of e-commerce brands that are trying to grow and trying to overcome some challenges, they sometimes they feel trapped, like they're not really going to get they don't have the funds in order to be able to take action and be able to move. So we're going to discuss how to solve some of that when it makes sense, when it doesn't. Tim, I don't know if you want to, or even Haley, if you want to open with kind of a quick summary for everybody so they understand, like, okay, what's in it for me? And then we'll jump right into a series of questions. And then, of course, we're going to open it up so that we get a chance to do some Q&A at the end with everybody who's here. So kind of get your questions ready as we go, but we're going to cover quite a bit of ground pretty quickly. So I'd like to jump in right now.
Sounds good. I'm happy to jump in first. For those of you that don't know me, my name's Haley Burt. I'm the Chief Operating Officer here at Canopy. And I think there are a lot of lending offers out there specifically designed for e-commerce brands, like Tim said. And we're just trying to help cover some of the cash flow challenges. The traditional lending market right now is not in great shape. So we just want to talk through some options for people who are looking for capital.
Very cool. Tim, you want to do an introduction for yourself?
Yeah, I'll keep it specific kind of the lending, but I started selling on Amazon in 2015 kind of by accident. And one of the biggest struggles we had is we were so successful that we couldn't come up with enough cash to buy inventory. Back then, the largest amount of money I'd ever had in my bank account at one time was early in my Amazon journey. I took an Alibaba pay later loan, which was a joint venture with Cabbage, who's now out of business. And they sent me like $280,000, right? And then like 6 months later, I took a big Amazon loan for about $1 million. And when $1 million lands in your account, it's kind of scary because you don't want to screw this up. And at the
Right.
time, I really didn't know how much that debt was going to cost me. I didn't know what my opportunity cost was if I didn't take that money. Um, but those were options that I didn't know enough about when I took them, and I wish I had. Now, going on into my Amazon career, I've owned several service businesses that supported sellers in various ways. And I've actually worked as a consultant or as an executive in a couple different financial technology companies. So I've gotten to see, kind of the under the kimono, so to speak, of how this industry works. And I'll tell you, I had to learn a lot. I learned a whole lot. Um, but I think that one of the things that was the most impactful to my understanding was just how little we as an industry know about lending and working capital. Some of the stuff that we've already mentioned, why to use it, when to use it, but also exactly what it is. And I want to demystify and maybe pull the
Cool.
sheet off of some of this stuff as well, which I think will be interesting.
Yeah, I think in our earlier discussions, you were talking about some of the things. It's like, here's some things that obviously there's some shady characters and shady situations that you don't want to get trapped in, and obviously we're gonna cover some of those. So I look forward to that topic because it's a little more dramatic, right? But at the same time, there's very good reason to do this. Now, a quick introduction about me, and then we'll jump right in here. So my name is Brian Johnson. I've been in e-commerce for a little over 15 years now, in the Amazon space for about 8 years. And I've had the pleasure of helping a ton of brands, I don't know, 20, 30,000 brands grow by over $2.5 billion on Amazon in my career. Really proud of that. Obviously, I've got a number of companies that have spun off of this, but today I get to simply just host this discussion with Haley and Tim. So thank you so much for joining me, and I appreciate you being here. So let's go ahead and jump in really quick here, and I'm going to start off with some questions, and then you can kind of narrate off of that, both Haley and Tim. The first one that I've got is what are some of the most common reasons that you've seen e-commerce brands actually need investment capital? You mentioned a couple there, Tim, but maybe you've got some other examples.
Yeah, I would say that 90% of it is inventory. That's the majority of what people need. Now, when you look at traditional businesses, there are a lot of needs for working capital, like investing in manpower or leasing a warehouse or buying equipment. Those don't necessarily have as much need in the e-commerce space because most of Like our equipment is done by the manufacturers. Our warehousing, we're typically outsourcing to 3PLs, or we're using FBA. Manpower, we're usually okay because we can operate with small shoestring teams and we can get a lot done. So inventory is the most important one. And when you think about even the biggest brands in the world, like Lego, they still borrow money for inventory, right? They still do, because even though they have the cash to buy as much inventory as they want to, having cash on hand is important, right? You've got to pay your staff. You should be paying yourself. You want to be spending money on ads and launches and ranking. You want to be doing all of those things. And when you buy inventory, you're essentially taking your cash and turning it into something that's going to sit in a box for multiple months. And then as soon as it sells, you have to buy more inventory, which is going to sit in a box for multiple months. You only end up having that cash on hand for a few weeks out of the year, and the rest of the time it's tied up. Also think about scalability. You know, if your business is growing 50% a year, you physically will never have enough cash to buy enough inventory for future purchases that you're going to need to be able to make to not run out of stock. And when you run out of stock, you lose ranking, you lose, velocity, you lose all of those things. So there's a big opportunity cost by not taking working capital as long as it's affordable. So yeah, to answer your question, I think it's inventory that's the biggest need.
Mm-hmm. I know I've seen a few brands too, maybe after figuring out some inventory challenges, that they're really top line focused. They want to focus on product expansion, adding things to their catalog. That type of product research and development can be pretty costly. And I think maybe taking some capital for that is a really good focus for brands as well, that we've seen. As well as creative services. So just getting that cohesive branding across the e-commerce channels so that you're preserving that customer experience on those channels, I think is a really great use of capital as well.
Yeah, and think about going into Q4. Would you rather have that money that you can be spending with your existing inventory on PPC to keep your rank higher? Or would you rather that money be sitting as inventory that you're not going to be able to sell until November?
Exactly.
So having cash on hand is a way to continue investing in your business without, without losing speed and losing velocity.
Mm-hmm.
Right. So then let's go take the opposite direction on this. It's like, where have you seen, with your experience, what have you seen that like just does not make sense as far as using that kind of capital? I mean, obviously there's certain things you want to throw at it, but you mentioned earlier, as far as like, you get a fat check, like in your case, obviously a very large one, right? $1 million from Amazon gets in your put in your account, and you don't want to screw it up, right? Because it's the whole lottery syndrome of like, oh, I've got all this cash, therefore I don't need to be as tight with every single penny, but you absolutely do. Where would you think, or where have you seen where funding has gone wrong, where it's been misinvested?
Well, the best story I could tell you is when I was working with a lending company as an executive, we had a guy in the UK that took a bunch of money and went and bought a Porsche.
Personal expenses, yes, a big no.
Yeah, and
why
I'll be
not?
honest with you. This may seem shocking to everybody here, but buying a Porsche does not help your e-commerce business, right? You can go out and get an auto loan that is actually cheaper than the loan that he got, for inventory, unsecured inventory loan. That was dumb, right? The other thing that I've seen people do is try to use that money for an investment that's not going to be recouped in the same amount of time that an inventory investment would be, right? So if I spend money on inventory, I should have that money back in my pocket and the loan paid off in 6 or 8 months, right? Like for the whole supply chain process, sales process, getting that money back 6 to 8 months. Well, if I'm spending that money on staff, I get, $100,000 loan, and I say, how I'm going to go hire a big marketing team because they're going to be able to increase my sales. That marketing team isn't going to be able to get you an ROI for a lot longer than that 6 to 8 months. It could take 12, it could take 24 months if it's brand marketing. You could go hire a team of VAs to create more efficiencies in your business. Well, that's great, but you're not actually going to get a cash-based ROI on that for a very long time, right? So when I think about mistakes people have made in borrowing money, it's by deploying it in ways that your ROI is significantly longer than the term of the loan that you want to be getting, right? You take an 8 revenue advance and you're investing into something that's going to have an 18-month ROI. Well, you're actually digging yourself in deeper, and you're going to be in trouble in 8 months.
Mm-hmm.
So I mean, does it make sense? I mean, my gut would tell me it's like, okay, rather than trying to figure out exactly how I'm going to calculate the ROI and everything, like after a while, it can probably get a little overwhelming as far as like just trying to figure out, it's like, oh, finances, I don't want to deal with it, therefore I won't. The inclination is like, well, I've got sales. Why don't I just like start, building up a savings and just, self-fund? Why wouldn't I do that?
Because most companies are growing so fast in the e-commerce space that they can never get ahead. Like, think if you're
Right.
like,
Because
I
there's a
should,
delay in the money coming in.
yeah, I
Yeah.
could model this out and show you, but actually the better your business grows, the more and more cash strapped you become. It's a problem. So people that don't find some sort of source of cash, not only can they not create a nest egg and self-fund, but they actually run out of inventory usually, and they end up losing velocity, and it's terrible. People kill their businesses by not having cash. Now, if you are, getting a 400% ROI on your products, and you can airship that stuff and it's quick and only takes 12 days to order and produce, maybe you can do that, right? But for most people, most businesses, that's not the case. The data I've seen, about 95% of the e-commerce Amazon businesses out there um, are not going to fall into that category where you can self-fund with with a substantial growth behind it. It just doesn't work.
Okay. For those who are listening in or possibly even catching a recording later on in the future, of course, this is live right now. So, for those who are in the room with us, of course, my question to you is, just put in the chat as far as like, have you taken funding or are you considering taking funding? I want to get a pulse as far as where everybody's at right now, as far as if this is a past, a present, or a future thing that you're considering as far as the need to get additional funding in order to accomplish some of the things that Haley and Tim have talked about here so far, before we get into some of the more specific, getting a little more granular as far as like what are the funding options and terminology. I want to make sure that we're covering some of the initial, so like what's in it for me, right? The initial of like, why do I need it in the first place? And chances are you're here because you already know that you need to solve a problem as far as cash flow goes. So probably don't need to go too deep into it. So Michael, appreciate your response on that one. So currently in various stages of underwriting, right? Let's actually jump in and go and talk more about kind of the overall process now. What are some of the options that we have as far as like, just like, what are some of the lending options that are available? Maybe some a little bit of differences between them so that everybody here can figure out, okay, I'm leaning toward this type of lending option. And then we'll go into some of the I'm sure there's a scary story or two that yes, I can tell by the smile that Tim's got. Yeah.
Tim has the kneecap stories. We'll get into that later.
Yeah, have stories.
I want to hear those too here.
Well, let's not lead with that.
Yeah.
So let me start off with the traditional types of lending that occur specifically in the e-commerce space. And we can't always call it lending. I'll start with that. A lot of what we see out there in the space are not loans. They legally can't be called loans. This industry is heavily regulated in most countries, and there are things that you can and cannot say. There are different structures of the type of capital advances or working capital or loans. Now, when we think about traditional lending, the way that works is you typically have a bank that's going to loan you money, and that money, you have a payment plan, and there's interest that is being charged to that amount of money that you have, usually on a monthly basis. And if you pay that loan off early, then you eliminate whatever remaining interest would have been on that amortization chart, right?
Okay.
The money that those banks are using sometimes is self-funded. Like a small community might have enough deposits from local depositors that have enough money to lend out. But generally speaking, a bank is borrowing money from local governments. Right. So when we talk about prime interest rates, things like that, what it is banks that are borrowing money at a certain interest rate from the government, let's say the US government, and then they're marking it up a few percentage points. Okay. Right. And I'll explain why that's important a little bit later on. For most loans that are coming through a bank that are getting the money from the US government or from the UK government, whatever it is, self-funding, that's your cheapest form of working capital. But most e-commerce brands are not going to be eligible for that type of funding unless they've been in business for multiple years, they have multiple tax returns, they have profitability shown on paper, they're paying taxes already. Typically, it has to be a business entity that's licensed in that country, and you have to be a resident in that country. You typically have to sign a personal guarantee on that money. Like, it is by far the cheapest. And the way that most people see that deployed is through a line of credit. So your bank, if you're eligible for this, is going to say, all right, you've got available $250,000, and you can take out chunks of that money as you need it. And each one of those is treated as a separate loan, right? They have their own schedule that you can select. They have, a standard interest rate, things like that. That's the best case scenario. But unless you've been in business for a long time, you're based in the US or the UK, and sometimes they require you to be selling there too. They want your inventory there. You're probably not eligible for that, right? So the second best type of capital,
the government lending is what you would not be
the traditional bank lending. Yeah,
I see, traditional bank lending. Okay, got it. Yep.
Yeah, traditional bank lending, who's getting money from the government, and that's why it's so cheap, right?
Got it.
The second best mainstream type of working capital for an e-commerce brand would be traditional lending that comes from a non-government backed source. Now, the company that I worked with for a couple of years, was SellersFi. And SellersFi was one of the only companies in the entire industry that had a true loan. And what they did was they went out and procured independent debt facilities. Okay, so where a traditional community bank is borrowing money from the government, SellersFi and companies like it go out and they basically get another bank or another lending institution to give them a line of credit. Okay, so that SellersFi might get $10 million in a lending facility, a debt facility, that then they can then deploy, and they're essentially marking up the interest rate to you. Now, these alternative debt facilities are more expensive than a government facility, right? But there's usually less restrictions. So SellersFi, at the time it was Sellers Funding, was able to give probably the most affordable e-commerce specific loans in the industry, because they went out and negotiated these really low rates for these alternative debt facilities. I'm going to come back to that in a little bit too. All right. So they negotiated really low rates with these debt facilities because they come from the banking industry, which is great. And they were able to deploy that capital. And there was restrictions on those types of loans. They typically required you to be based in specific countries. You needed a business entity within the US. There was a lot of restrictions, right? And most companies that advertise e-commerce working capital cannot facilitate a loan. They can't do that.
Right.
So the third type, which is the most common that is deployed in our industry, is what we call a cash advance, a merchant cash advance, an MCA.
Okay. Now, is that similar to a credit line? Or
no,
is it a single instance?
It is typically a single instance.
Okay.
And the way that this works is, if you apply for a merchant cash advance, which has less regulations, by the way, the government regulates this less. So you can cross borders, companies can loan these to people all over the place. The way a merchant cash advance works is, if you apply for $100,000 working capital line or cash advance, they charge you the fee, not an interest rate. It's a fee when that cash is deployed. Now, it can work in two ways. If I want $100,000, they might give me $100,000, but I owe them $110,000. Okay, so the cost of that capital is 10% of that amount that I took, right? The other way that they charge you is they say, all right, if you're eligible for $100,000, we're going to deploy $90,000, but you still have to pay us $100,000, right? So they can tack on the fee, or they can give you the amount less the fee, right? So they're deploying you your approved amount minus the fee. Now, what's interesting about this, it's easier to get this type of money. It's less regulated, so more people are eligible for it. But even if you pay back that amount early, you typically don't get any breaks. So on a loan with interest rate, if I take a 12-month loan at a certain interest rate and I pay that amount the first month, I've almost gotten that money interest free, right? With an MCA or a revenue advance, it doesn't work that way. Sometimes there are companies that will give you a bonus. They'll say, hey, if you pay us back early, because they want that money back early too, they'll give you a little bit of credit for it, but it's not equal to, like getting rid of your interest.
Yeah.
Now, these cash advances are interesting because they advertise a lower rate than a typical interest rate. So a good interest rate on a loan in the e-commerce industry is 15 or 17% annualized interest. Okay.
Ouch. Okay.
That's good. Now they have to come from these independent facilities. Like, it's expensive. You're marking up something that's already very expensive.
Right.
So these merchant cash advances come out and they say, hey, we're going to give you this advance for as low as 6%. Now, if you look at the fine print, it might be 6% fee for a 6-month term. Now, if you actually do the math and you translate 6% of $100,000, so $6,000 for 6 months, and you compare it to an annualized interest rate, your cost of capital can be the equivalent of 30% interest rate. All right. So don't get confused with a fee and interest rate, because we think, well, why would I take a loan at 15% when I can get this revenue advance for 6 months for 6%? The cost of capital is actually substantially more expensive if you amortize it out and you compare apples to apples. So don't get caught in that trick.
Yeah, I can see where, I for one, and anybody who's in the audience, if you're feeling like some of the overwhelm that I have right now as far as some of the terminology and everything, for me, I'm going to go back. I'm going to go back. I'm going to have to listen to Tim a couple of times here on this on the recording. So I'm going to make sure I get a hold of that just so I can so it all sinks in the second and third time I hear it. So, but I appreciate you getting into the detail, because I think it definitely, you don't want to gloss over it, because there's some very specific points, and we'll get to things as far as the red flags that to look out for, because what I have seen, and certainly the discussions that I've had, is that there's a range of offerings for lending. Some of them are simply just, like you said, traditional. Some of them are cash based. Some of them are maybe even equity plays or profit sharing, or there's some more there's more variety available, but that also introduces some good and bad players out there, right? So the next thing I want to transition into is, what are some of the things, including red flags, that you would recommend, that each of you would recommend that we look out for, to know, okay, I need to continue this conversation or go after this type of lending, or here's the reasons why I should avoid option A or option C. I'd love to hear, as far as like, what do I need to know to protect myself?
Yeah.
Before we get into that, I have one more question for you on the different types of lending options available, and then we'll jump right into that. But I know Amazon now has its own Amazon lending built within the platform, where you can get up to $5 million, and they say it's traditional term loans and lines of credit. Is that kind of more of the MCA model you're talking about? It sounds a little different the way they portray it.
If they're calling it a traditional loan, legally it has to be a loan. It has to be an interest-bearing loan that if you pay it back early, it's great. Now, Amazon Lending used to self-fund those things, and it was wild. It was Wild West. They were giving money to people that shouldn't have gotten money. Then they stopped doing it, and several years ago, they partnered up with Goldman Sachs, and Goldman Sachs was underwriting it. It was very hard to get approval, though. It was very, very rare for someone to actually get money. Now, they are, again, giving working capital, kind of like Shopify Capital does, but it's usually white labeled from a different lending institution. Right. And getting approved is actually very difficult, difficult. And I'll explain what's happened in the banking industry that's caused that. But they definitely advertise it. If they call it a loan, it must be a loan. And Amazon is typically offering loans to just give you the money for inventory so that they can get more sales. They don't really make any money on that. So it can be very cost effective and very affordable if you can qualify for it.
Yeah, because Amazon's got they've got the visibility as far as your sales velocity through their warehouses. So they understand, like, hey, this is a popular product, it's moving out the door. Let's make sure that they don't stop for 3 months waiting to get funding. Let's Grease the
Because if they,
kids.
if they facilitate cash for us, they make a lot more money on our sales than they would at jacking up the interest rates on us.
Definitely. And then as far as the terms, I know you said it's hard to get it, but I know they require you're on Amazon a year, probably they need that data. And then since they're using the inventory and the brand itself as collateral, I think for people that default, they just take over that brand within the platform. It's already on there and just sell the remaining inventory. And if they like it, I guess keep it going. So maybe that's where the stringency comes in, whether that's a brand they want to adopt or not.
Well, typically they're also going to take a personal guarantee. So you have to have some sort of assets. And if you don't pay that back, they can come after your house, they can come after your car, it affects your credit rating. You have to have a good credit rating before they'll even talk to you, right? Typically, they're not going to take your brand as collateral, but they can take the inventory as collateral. Right. So the more inventory you keep in FBA, the better. And sometimes I've even seen specific, especially when you get into $1 million more lending amounts, they require you, for example, to be FBA only so that they have control of that inventory. And they'll even do things like increase your IPI score so you can send more inventory in so they've got their hands on it, as opposed to keeping that in a third-party warehouse where they can't grab it.
Yeah, yep, that makes sense. I know there's another option, Payoneer Capital Advance, specifically for Amazon and Walmart brands too, up to 750,000. So maybe a good option as well for the smaller brands.
So the way all of those cash advances work, whether it's Seller's Fire, Payoneer, or Uncapped, or any of these, right? The way it works is they look at your cash flow within your bank account, and they look at your sales performance on the marketplace. And Brian, I haven't forgot your question about that fourth type of cash options, right? The scary ones. But yeah, to qualify, typically what they do is you connect your marketplace account via API where they can download all your reports. They can see, all of them have a different algorithm. How consistent are you in inventory? What's your growth consistency? Have you been suspended? Do you have red flags on your account? Things like this. And then they also connect to your bank account, usually through Plaid, which is the most popular connecting device. And they look at your cash flow in your business, and they make sure, hey, there's not a bunch of dumb stuff happening. He's not always he usually has a cash reserve where even if something happened, he could pay back this loan. So they all have their own algorithms in which, they're going to determine your risk. And then they combine it with their risk tolerance. And then that's how they give you your offers.
Very cool.
And they
just
all
kind of quick housekeeping.
They all have a different, I want to really stress this. They all have a different algorithm. So just if you're trying to get an MCA through Payoneer and they reject you, go back to Seller's Fi and check with them. And if, their amount is lower, go check Uncapped, and shop around for those, because they all have different qualifying, algorithms.
But then also, of course, make sure that we'll get in as far as like the terms within those offers to see like really how to filter out the good from the bad. Quick point to the audience, of course, is that I do see your questions. We're trying to cover very I said a very information rich amount of on this topic, and we only have about an hour in order to commit to it. So I'm intentionally we're skipping over certain things that, yes, I appreciate your questions on that. We'll try to address those at the end. So just want to let you know, I do see it. We will get back to it as long as time allows. So thank you.
Awesome. Yeah, I mean, I think the only other option I know of that we haven't talked about yet is just more of a traditional investment from a private equity firm. Normally only happens for larger brands around the 10 million mark. And I would say in this economic climate, probably pretty challenging unless you have some really good profitability and growth trajectory there to get capital that way.
Yeah. So what's happened, and I've alluded to this a couple times. Let's go back to those debt facilities. Okay. Those debt facilities where the money actually comes from, their interest rates have gone up. So that's made lending become much more expensive. In situations where a lending company or a cash advance company pre-negotiated low rates for 3 or 4 years, which they've sometimes done, What's now happened is those debt facilities, instead of lending that money at a loss to them because they have agreed to charge 3%, but it costs them 9%,
Right.
what they're doing is disqualifying people and just not approving lending. They're just not doing it.
Mm-hmm.
So what we're seeing is companies that offer a low amount, a low fee, a low interest rate to get people in the door, but those people are typically not approved. And then the money that they become eligible for comes from a debt facility that is more risk averse and is much more expensive. So the market has completely changed these debt facilities and the cost of capital for the lenders or for the advancers, which is now trickled onto us. So for companies that are growing, e-commerce brands that are growing, and they want to access capital, you're just going to have to pay more. That's all there is to it. You're going to have to pay more. So what you want to do is you want to try to keep those terms as short as possible. You want to make sure that you're eking out every single dime of profitability you can in your business where you can get those things paid back and afford to have a short term.
Mm-hmm.
And you want to make sure that you are decreasing the amount of time it takes you to turn inventory, right? There are people that used to ocean ship inventory and now are paying more to airship it because scraping a month off of their borrowing term actually saves them more money than the difference between air and ocean shipping.
Wow, that's a huge amount too.
Yeah.
Dang,
so you
okay.
can get really creative in lowering that term because especially for a cash advance, the fee percentage that you pay typically increases the longer that term is. So an 8-month is going to be, even if it's 6% for 6 months or 6% for 8 months, that typically doesn't happen. It's usually 6% for 6 months and 9% for 9 months. I'm just making up numbers. Don't let me quote that. That's not a quote, right? But they're going to charge you more to stretch that money out longer. So the shorter period of time where you have to take that term, the shorter term length will save you money. So increase your profitability, reduce your churn and your turn time on inventory, not your churn, your turn time, and try to take a shorter term on that cash.
Right.
And don't get freaked out if it's expensive. If you do the math and you realize, hey, this 8% cash advance, which is the equivalent of a 20%, amortized interest rate, like that sounds expensive, but also calculate your cost, your opportunity cost if you don't do it. If it's $100,000 that you might have to pay $20,000 on, $20,000 is a lot. But if with that $100,000, you can then in that same 6 months make another $60,000 with a 30% profit margin or whatever, then you can't afford not to pay that $20,000 because that turns into $40,000 of extra profit.
Okay.
Right. So don't be scared of it. Use it, but use it wisely and just try to use as little of it as possible for the shortest amount of time possible.
Okay. Question for you. So to kind of back up a little bit here, to kind of like maybe use shorter words for me. On when we're talking about as far as like you've got like a 6% interest rate, but then there's the annualized rate. Can you kind of summarize the math on that so I can kind of get it through my head as far as like the difference between the rate that they state versus the annual?
Yeah, I'm not a banker. I can't explain this perfectly,
Do you play
but
one on TV?
yeah. So let's say that I take a 1-year loan at 6% for $100,000. Okay. My total interest that I'm going to pay, if I stretch that loan out to the full schedule, total of 12 months, and I'm paying it back monthly, okay, is $6,000. So at the end of a 12-month period, paying back monthly, I will have paid $106,000. Most of us understand that, right? Now, a merchant cash advance that let's say is 6 months still charges $6,000. Okay. So think about that. You can have a 12-month term that costs you $6,000, or you can have a 6-month term that costs you $6,000.
Okay. So you
Plus,
got time and half, and it's almost like doubling the interest rate.
Plus, most of the most of the merchant cash advances make you pay biweekly. Okay. So you're actually paying back sooner than monthly because in the middle of the month, you're paying them. So they're actually getting their money back faster. You have less cash on hand because instead of monthly, you're paying biweekly. So when you consider all of this and you build out an amortization schedule that basically reflects that, a lot of times you go from, what you think is a 6% interest rate, that 6% fee over 6 months can actually be the equivalent if you had taken a 12-month loan for, a significantly higher amount, 15, 18, 20% interest rates, right?
Okay.
So it's not apples to apples. A 6% fee is not the same thing as 6% interest.
Okay, so really, we should be a lot more careful to paying a lot closer attention to the amortization schedule to really understand what the total cost of the loan is, not simply just an upfront number that says like, well, that seems low to me, but then really saying like, okay, what's the total cost of this loan and how does that impact my overall profitability, my brand?
Yeah, it's cost of capital. What's your actual
Right.
cost of capital? Think about it this way. If I take a well, just apples to apples, a 6-month loan, or I'm sorry, a 12-month loan and a 6-month cash advance, and both of them are, one's a 6% fee and one's at 6%. My 6% merchant cash advance for 6 months, I'm going to get charged 6%. I'm getting charged $6,000. But if I pay back my 12-month loan in 6 months, I will have only actually had to pay back, I don't know, $3,900 or something like that.
Right.
Right. So
Yeah.
a 6% interest rate costs you a lot less than a typical merchant cash advance, even if you pay in the same amount of time, as long as the term that you take on the interest bearing loan is longer, right? And you pay it back early at the same amount of time as merchant cash advance. So that's an example just to show you like they are not apples to apples. 6% fee is not the same thing as 6% interest. Interest is always going to be a lower number.
Okay. I appreciate you kind of breaking that down for me once again because I know I wasn't the only one who was kind of like, when it's like, okay, scratching my head. I'm like, okay,
Listen, I'm just throwing out numbers. My math is still wrong.
Yeah.
I can't
No,
do it in my
I
head. Like,
understand.
I
It's
have
kind of more
banker
of a
buddies that
reference.
I send these term sheets over to and say, can you tell me the actual cost of capital? And they compare it. But
Right.
yeah, the main thing is they're not apples to apples. A fee is not the same thing as interest, but that's how the merchant cash advances are marketing it. A bank comes and says, hey, we can do a line of credit for 7%, and Payoneer says, oh, we can do a cash advance for 4%. And what they don't tell you is it's 4% over 4 months.
Okay.
Right.
Right.
So the marketing can be deceiving.
Right. Exactly. Yeah. This is one thing that I just noticed here that as far as the audience here today is this is what I love about being in the Amazon community is we actually have Kevin King in the house here, and so he's saying he goes, I can actually talk about the MCAs if you want. I'll probably table that for the Q&A section, but I appreciate your willingness to jump in there and help us on that too, Kevin.
Yeah, Kevin's got some war stories about MCAs.
Yeah, well, that's really what I'm going for is I want to hear the war stories at the end. So let me kind of get back on track here because I know that we're burning through time. Were there other kind of I feel like there's a lot more that we could talk as far as like red flags and what to watch for. I want to make sure that we're covering things as far as like try to avoid this, try to go after this, like know where kind of the lane that you should be in and what are the red flags and the signals that say, okay, I don't want to go over on this side. I don't want to be lured over by the marketing into a bad deal.
Use the sniff test. If you easily can understand your cost of capital, that's a good thing. There are a lot of cash. So I'm trying to think of how to word this. Suppliers of cash that are so complicated that people are signing these documents, these term sheets, and still don't know how they work.
Right.
There are companies that do crazy things like analyze the amount of money that you think you need over the next 12 months. And then they start deploying small amounts of that money. They say, all right, over the next 12 months, you're going to need $100,000. Great. What we're going to do is on week 1, we're going to give you $10,000 for an order. And then on week 6, we'll give you another 4,000. And on week 7, you pay back 3. And on week 9, we give you another $10,000. And on week 12, you pay back another 4. Like, I have looked at some mainstream options at their term sheets, and it's taken me an hour to review them. And I'm still so confused that I can't screw my head on straight at the end of it. I took an offer like that, sent it to one of my banking buddies, and I said, what's my cost of capital? And he said, Tim, this is so complex, but my closest math is that the cost of capital would be the equivalent of about a 250% interest rate based on the time that money is actually in your hands, how soon you're paying it back, and the fees that they're double stacking on you. Right. So remember when I talked about the way that a merchant cash advance could charge you, they can charge you on top of the amount. So they give you 100, you pay back 110, or they qualify you for 100 and they actually deploy 90, but you pay back 100. One of these options with a 2-page sheet was also charging you a fee. So they would charge you a fee like a merchant cash advance on top of the amount, and they were charging you a fee by deploying less than you were eligible for. So the marketing was saying, oh, we will do this for 12 months. We'll supply all this for 8%. But when you actually looked at the way they were double charging you and maybe stacking interest rates on top of that, your cost of capital was like 19%. And because that money was never just deployed to you up front, they trickled it in and they trickled it back to them. It was safer for them. That's where your cost of capital becomes equivalent to if you taken a 300% loan, right? It's insane.
Yeah.
That's what I see commonly is they'll only include to get you in just a part of the terms. So they'll just include a rate or just include like a time frame, like, no, you don't have to pay back for this long, but they won't, you really have to dig in to uncover those different pieces, like you're saying, Tim, to see in the end, is there a penalty for paying early? Like all of those different pieces add up for that, actual cost of capital. It's super important.
There's also a mainstream lender in our space that goes to a lot of conferences that I call it the mafioso lender. And what they do is they say, we will provide you the amount that you need, and we'll consider it an investment into your business. And what we're going to do is we're going to take a portion of your profits from your business. What they don't say is that the portion of that profits, and they advertise it well. They say, oh, if you have a great month, you pay a little more. If you have a slow month, you don't have to pay as much. What they don't tell you is that the amount that you're paying them does not go back to paying back the money that they gave you. So you can get stuck in perpetuity doing this. So what you have to do is you give them a percentage of your sales or a percentage of your profits. There's different numbers, different ways they do it. Right. And until you can save up a nest egg big enough to pay back the original amount, you're stuck with them. And it's not regulated. And they can qualify nearly anybody they want to because it's very low risk for them. So they make sure that your company's profitable first. And they say, we're going to take 20% of your profits, 25% of your profits, and it'll be great. We can deploy the money tomorrow. But then they own you. They own your business.
Yeah, so it seems flexible, so people sign up, but I think a true good flexible option for payments, Payoneer and Amazon lending, you do get to pay those back as your sales come in, because like you said, it's hooked up with the API and the Payoneer sense, so they see when you're generating revenue, and then they just take a portion of that. But they don't do it in perpetuity and own a percent of your business.
Yeah, you can read that on a term sheet. Like, it makes sense. That's why I said use the sniff test. Like, if you can easily understand it, it's good. If it's so confusing that you have to send it to other people, they're probably hiding something. Right. And I've had people send me these term sheets and say, can you decipher this? And I'll look at it for 2 hours and go, I can't. Like, it's so convoluted and so complex. I can't figure this out. And these are mainstream companies that have been mentioned in our chat today.
Do one of the questions that came up that it's come up a couple of times. So with MCAs, as far as early payoff, can both be offered as far as early payoff or not early payoff, or is it always no, you're in the full length?
Yeah, typically what they do is they give you a bonus. So let's say that it's a 12% fee for 12 months. If you pay it back in 6 months, they're not going to take off 6%, right? They're not going to refund you that, but they might give you a 2% break or a 1.5% break. So you're incentivized to pay it back early, but it's not going to be the same as if you're eliminating the interest by the term, the term of the loan.
Mhm.
Okay. I'm glad we're gonna have a replay on this, because I'm gonna have to, like I said, I'm gonna have to watch this at two
I know
or three
we could
times.
talk about this for hours, and I could
There's no
illustrate
way
with
we're gonna be
drawing
able to cover
charts.
everything. Yeah,
Yeah,
because I've got so many more questions I want to ask, as far as the particular, but I think that for the sake of time and for everybody who's on the call right now, focusing more in on like we need to gravitate toward the good and get away from the bad, maybe one of those things where I kind of want to inject a I don't know, maybe it's dramatic, but to interject kind of a horror story of, here's what you don't follow this, this other example. I don't know if you have any of those off the top of your head. I'm sure probably Kevin does. I think you said, as far as just kind of make us appreciate that we need to pay closer attention, not just give up on and don't go after lending, because there are good lending, there are good terms out there, and I do want to readdress those. But maybe without obviously I don't want to slander any companies, because they do sponsor some Amazon events, but I do want to make sure that that maybe there's an example of, hey, here's kind of an example of a bad situation where somebody got caught by it, and then we can go into, okay, here's some of the indicators we want to look for that are positive, that are good, focus on these. I'm sure we could easily make this into a
I
bad
will.
point, but
It's hard to give specific examples without calling people out, which I want to avoid doing, just to be a little PC. But there have been a lot of companies, a lot of brands, and we saw it in here in the chat. I saw someone talking about MCA stacking. This happens a lot. So what these companies will do, the MCAs,
within the same lender or different lenders?
within you can do it both. It can be both.
Okay.
What they'll do is, let's say within the same company, what they'll do is they'll say, hey, you've got a 9-month term. Well, they might start offering you money again after 6 months, right? Well, you
You're
can
still
take
paying off the first one. Yeah.
you can take a larger amount. Now you're paying for that 3-month overlap, you're paying twice as much. And a lot of times what they'll do is they'll take that second amount to pay off their first amount. But you're not saving the money in interest. You've still got a fee. So when you start stacking those up, you're actually paying a lot more money for that money. And then you can take cash advance from one company and qualify from a second company. Well, the problem is, if you're not profitable enough, and if you can't deploy that money fast enough to turn that money around in your 4 to 6 months from inventory, then what you end up having is a bigger cash flow problem, because you got to pay that stuff back, right? So think about a 12-month fee-based MCA where they're taking money directly out of your Amazon payments. They're taking certain $1,000s, every couple of weeks. Well, if you stack that up, instead of doing a 12-month, you do 2 6-months, or you do a 6-month and an 8-month. Well, they're taking a significant amount of cash out of your account, like starting on week 2. Sometimes there's a delay, like Sellers Fi. Sometimes we do like a 3-month delay, but most companies don't do that. So what happens is you've deployed all this cash that's tied up in inventory for the next 6 months. You're not going to see that cash back for 4, 6, 8 months. And now you're paying back 1, 2, 3 withdrawals every 2 weeks. You can actually run out of cash, right? So then people say, oh, if I'm going to do that, I can take another MCA to pay that back, and then I'm stuck with one. But it doesn't work that way. Now your cost of capital is 4 or 5x in cost, right? But it's like a trap.
You're starting your own Ponzi scheme.
Yeah, you're basically robbing Peter to pay Paul, but like Peter doesn't go away. Like Peter still needs to get paid, right?
Mhm.
Yeah, I see that the number of businesses I've seen ruined by that is significant. And then the other thing is people just don't understand how this industry works, so they don't understand the true cost of capital. Like, always ask yourself this: what does it actually cost me, and is it worth it? Is this going to actually cost me 20%, or is it going to cost me 50%? Or, what is this going to cost, and is it worth it? And I have advised people to take loans at 20%. I've advised people to take merchant cash advances at a 25% fee, because if they're profitable enough on their products, and it's the only type of money they can get, and their option is lose these sales or get these sales, and the profit margin is so high that they can afford that cost of capital, do it, right? Do it.
Is there kind of a rule of thumb on that as far as like if you're 50% net profit, then you can absorb a 25%?
No, because you'd have to like calculate the time of the terms, the term length. You'd have to calculate how long your inventory is tied up. Most
Well, and
people
frankly,
that are
most
running an
brands
Amazon
don't know
business,
their total cost of doing business anyway.
yeah, they don't know your
So
total
it
cost of doing
varies
business. It's
heavily.
tough.
Yeah.
Yeah.
I mean, you can look at the debt to income ratio. Maybe I know that's used sometimes on a personal level, but if you're paying more than around 35-40% of your income back into the debt that you borrowed, the money you borrowed, I think that's generally considered high.
Yeah, it's
So
pretty high.
probably getting above that is, whether or not you know your profitability, you're probably getting into some tough waters if that's the case.
Right.
Yeah.
I wish we had the time. Man, this is so dense. I wish we had the time in order to go into more detail as far as like some of the the qualifying terms and some of the other programs that might be available, kind of alternative funding, for not having good cash reserves and these kinds of things. But let's it seems to me like a lot of this is focused on the MCA side of the house, right?
We do have a part 2, right? Is it in
Yeah,
2?
no, that's true. Yeah, thank you,
We
Haley.
have more
Yes.
time to cover this.
We do have a part 2, and we're going to go into even more depth on this. So what I would recommend is certainly go back and listen to when the replay gets sent out. We are recording, so assume we're going to send out a replay. Go back and listen to this a couple of times, and then prior to our follow-up webinar, that's with who's that? That's Caroline
Caroline from Sellerify. Yep.
Yes. Okay. We're Solidify. Okay. Cool. Thank you. I was drawing a blank because I'm in a hotel room, so that's my excuse. But
And Patrick as well, our chief brand officer, will be there.
oh yes, right. Who has a Wall Street finance background
He
too.
did work on Wall Street, yes. So he's definitely has some. If you want those kneecap stories, Brian, we'll get there one day.
That's right. Yeah, we hire smart and violent people. Yes, that's true. The I guess as far as like, I mean, because we're at 1 hour right now, so and I want to give a chance to answer some of the questions that may have come up. Gosh, kind of want to where do I choose here? I kind of would you mind kind of reframing kind of the do this, don't do that, kind of like in as short as you can, look for this kind of a rate or this kind of terms.
Yeah.
Definitely avoid this kind of a situation, this kind of a term.
Yeah. Try to get a traditional loan. If you can't get a traditional loan, get a cash advance for the shortest period of time that you can afford and the lowest rate possible. That includes a delay in payment. So say if it's a 9-month term, they're not going to take any money for the first 2 or 3 months because that can get you in a cash flow problem. And there are companies that offer that. Also make sure you understand your true cost of capital. Understand what that is. Make sure you qualify for these specific companies, whether, where you're based, where you're doing business, a lot of those things change the legality of what people can do and the risk tolerance. If you don't get a good rate or you don't get a good offer, wait a week, because a lot of times those debt facilities are fluctuating around and a week later can make a big difference. Never take the highest amount that you can. Take the lowest amount that you possibly can. Don't take extra money. If you need $20,000 for an order, take $20,000. Don't take 40, because that money just sits in your account. You're going to be tempted to spend it on something you shouldn't.
Yeah.
You can usually take 20 now and take 20 in 6 weeks. Don't take 20 now, or don't take 40 now. Take 20. The things that you shouldn't do, you should never stack loans if you can avoid it. You should never sign a piece of paper that you don't truly understand. You should always send a term sheet to a friend of yours. Hey, am I missing anything? Someone that knows the industry, someone that understands banking. Get a second pair of eyeballs on it and say, am I missing something here that I don't understand? Because most of us, like I said, have either learned this industry from the lenders, just like the mortgage industry taught us about home loans and it was all wrong, right? Or we just haven't had experience seeing this, and we might not know what other options there are, and a buddy might be able to point us in the right direction.
Yeah, I know certainly. I've definitely seen firsthand where somebody has trusted what a lender has stated verbally to them, and they go, "Well, I trust them because they seem to know what they're doing," right? And you gloss over, you skip over looking at the actual term sheet. And you make a really good point is they're going to tell you whatever you want to hear in order to close the deal when it comes at the end of the day. But if you don't understand the term sheet, take the time to understand the term sheet, because if it's so complex, complexity is usually a tool to hide something.
That's true.
So you want to make sure that you're not simply just taking what they are telling you from a marketing standpoint at face value. You're actually understanding the terms because you are contractually obligated to pay it back, and in addition to whatever terms they choose to add on.
That's true.
Okay.
So
Before
stand by for part 2.
Yeah, I know, right? I think part 2 is in September, if I believe. I think that's the timing on it. I want to say it's September 7th, I believe. That date may change, but that's kind of what we're shooting for. I want to open it up first so that each of you, Tim and Haley, thank you both obviously for joining me. Obviously we didn't get through everything that I wanted to get through. I still have a dozen more questions to go, but I do want to allow more room, less for my questions and more for those who are still with us in the room, in the audience, to be able to ask a couple of questions. Let's try and keep the questions focused, but I do want to give both Tim and Haley a chance to kind of have some closing statements and opinions or suggestions before we go into a brief Q&A.
Okay. I think we covered a lot of great stuff here. Tim, you have a great amount of knowledge and specific knowledge from your self-fied days. So thank you for bringing that to the table here. I know I might advise brands looking for funding to go category specific. There are some investment bankers or M&A advisors that maybe if they're not going to hook you up, just point you in the right direction for options. I know we've had a few brands within Canopy that have worked with these types of category specific, pet specific type M&A advisors who, like you said, Tim, it's a good second set of eyes. They're generally gonna, maybe you're not going to qualify for what they can offer, but they'll be able to point you in the right direction to what your best options are or look over something for you. So that would probably be my last parting advice here.
Okay. Haley, if people want to reach you, what's the best way to do so?
Yeah, I say either LinkedIn, Haley Burt, or Haley at canopymanagement.com. And I'd be happy to answer any other questions.
Fantastic. Appreciate you being here. Thank you.
Thanks, Brian.
How about yourself? Your last wisdom on this one.
Last piece of wisdom is don't be intimidated. Like, nothing that I explained today is overly complicated. It's just complex. You can break it down into little pieces. But the information that you need is out there. You just got to dig around for it. Ask ChatGPT, what's the difference between a merchant cash advance and a loan? Almost
use that
everybody
option frequently. Dumb it down for me. Tell it to me like I'm my son.
I'm sure that everybody in here is in some sort of community or has access to community. Ask other people, what are you doing? How are you finding lending? The Amazon seller forums are great because people are always talking about options that are coming up there that other people might not be aware of. Right. There's a lot of options. Don't be intimidated. Just go out there, do some research, ask around, and you're going to find great stuff.
Fantastic. Thank you, Tim. Tim, how can people get a hold of you?
LinkedIn's the best. Just Tim Jordan, Amazon, and I'll come up.
Or join us over at Podcast Movement Conference. That's where Tim and I are both at right now. So
we're in the same. I guess we're in the same hotel.
No, we're in the same hotel. Yeah. So I'm here with Brian Burt. We ran into Tim and Bradley also. All of us looking at launching our next version of podcasts, and so look for announcements from each of us in the coming months here, as far as when we launch those podcasts. Keep an eye on that. So that'll be fun. Cool. As far as those who have additional questions, some of these questions are certainly, there's a lot of different, creative lending and that kind of stuff. And I know that we don't have the time for that. So if you have a question that's still pressing that you really want to get answered right now, if you want to throw it into the chat right now. We'll take probably maybe one or two last questions. And then the rest of it, we're probably gonna have to pick up on the second part in our next webinar next month. But for now, if you have any final questions before we close it out, go ahead and post that right now. Let's see here.
For anybody that wants me to name specific companies, I'm gonna avoid that.
A good kind of question on this is like useful resources in order to study. I think you'd mentioned, obviously, it's like that's kind of is definitely, it's a hack that works, is use something like a Chat GPT or a or a Bard or a Claude or something like that in order to ask some questions of like, okay, break down some of these financial terms for me. How do these relate to each other? I use that frequently in order to just study up on a topic that maybe I've forgotten or I'm not that familiar with. So that's a great way of doing it. But certainly any other additional resources. Is there any kind of a go-to resource that either of you would recommend for people, or is it more of a, hey, here's what's kind of working now and here's what to avoid?
Yeah, I'm not aware of any great resources. You can go to, you can research e-commerce blogs, and there are companies that break down on a light level, different solutions out there. But e-commerce is such a new thing that traditional lending doesn't really want to touch it yet. And there's not a lot of resources out there, unfortunately. It's word of mouth, it's the forums, it's communities asking for people's, experiences. There's just not a lot out there right now, unfortunately.
Right.
Mhm.
Do you have one of the questions that just came up? So, I mean, I appreciate that. That is kind of answer what I suspected, is that there is information out there, but it's not like in a tight little, like, hey, here's a pamphlet that'll answer all your questions. But I think that's obviously, the smart play, of course, is to plug into discussions like this, certainly the one we have in September, going back, and like what I'm going to do is watch the replay a couple of times, and then do, follow-up questions, of course. One of the questions that came up, Muhammad was asking as far as like regarding the NFTs and tapping into the existing consumer base. Have you worked with NFTs at all?
I've been so distracted by other things. I know very little about it. That would be a good Kevin King question, though.
Yeah, I don't know if Kevin's still on, but
No, I think he left.
okay. Yeah,
I think that probably covers enough to give everybody a headache.
Yeah, no, yeah, for sure. It can be dense, but those who take the time to study this, of course, you're going to get a definite competitive advantage because they can continue to move their business forward successfully and avoid some of the traps. But like you said, is what I kept on hearing throughout was make sure that you clearly can understand the term sheet. If you do whatever lending you do, obviously there's multiple ways you can go back and try again at different points and to get different rates and terms. But definitely make sure that you are very clear on the written terms that you're signing, not the verbal marketing terms that somebody is either focusing on or glossing over. I think that kind of wraps it up as far as the questions. Some of these are definitely deeper questions that we'll get into in future discussions. Tim, absolutely appreciate you joining us today.
Yeah, thanks for having me on.
Haley, I know you've got a very busy schedule, so I really appreciate you taking the time out of your day in order to jump in here with Tim and I. And thank you everybody for being here. We look forward to seeing you. We do typically send the replay out within a couple of days, so look for that. Study that, of course, and then of course look for not only our next webinar, which I think is going to be probably early or mid-September. With Carolyn from Sellerfi to go into even more depth on this topic and get more answers on some of the questions we've got, certainly the questions I've got, hopefully. And then of course, look for future announcements. Certainly Tim and Brian and I, we do have podcasts that are planning on coming out, and look for those announcements both from the Canopy side as well as the Carbon 6 side. So yeah, be good. Thank you. Also appreciate the feedback, appreciate the compliments, and we'll see you on the next episode. Thank you, everybody.
Thanks, everybody.
Bye.